Well, it's happened. We have a new tax act. It's called the Tax Cuts and Jobs Act, and it was passed by the Senate on December 19th and the House on December 20th. The President is expected to sign it, but probably not until January 1st of 2018 because of a few procedural items. Virtually all provisions will take effect in 2018, and the majority of taxpayers will end up paying less tax. Although if you live in California or New York, high-tax states, and you have mid to high income, you probably will pay a little bit more in tax. I want to go over some of the major individual provisions so you know what's changing and what's staying the same. So let's start with there's 7 tax rates that will start at 10%, will go to 37%. Currently, we're 10% to 39.6%, but each rate along the way is a little bit lower. There's a higher standard deduction, $12,000 for single, $24,000 for married. Currently, it's about $6,350 for single, $12,700 for married, meaning that your itemized deductions like medical deductions, home mortgage interest, property taxes, state taxes. So anyway, you take either the higher that or standard deduction. So less people will be itemizing going forward. There is a disallowance of exemptions. Right now you get to deduct $4,050 per person in your family. That goes away, but the child tax credit goes up to $2,000 from $1,000. So if you have kids that are 16 and younger, you'll probably be okay because of that. Medical deduction, that actually is retained. There was some discussion that that would go away. In fact, in 2018 and 19, you have to get over 7.5% of your adjusted gross income. Currently, it's 10%. The state and local tax deduction, that's the biggest one. That essentially goes away with one exception. You're allowed to take $10,000, any combination of property taxes and state income taxes. This is what's going to hurt the people that are in high-tax states. Mortgage deduction, that's retained, but now you can only have a loan up to $750,000 and be deductible. Don't worry if you have a loan that's $1 million, as of December 15th of 2017, you get grandfathered in, so you can deduct all the interest on that. Realize that starting in 2018, you can no longer deduct your home mortgage interest, or I should say your home equity interest, on home equity type loans. Charitable contributions are retained, so continue to give to charity. There's no change there. Miscellaneous itemized deductions, those go away. So unreimbursed employee expenses, investment expenses, tax prep fees, things like that, those are repealed. So none of that starting in 2018. Capital gain rates, that stays the same. There's a 0% rate, 15% rate, and 20%. No change there. That's for long-term capital gains. You hold an asset for a year or longer. You get that special rate, or qualified dividends. The alternative minimum tax, it's not repealed. It's still here, but the exemptions are at higher amounts, so less people will be subject to that. A state tax exemption, if you pass away, that doubles. So it's going to be $11.2 million per person, $22.4 million for a married couple. The residence gain sale exclusion, there was concern that that would change. That's going to stay the same. You live in your home 2 out of 5 years. You're single, you get a $250,000 gain exclusion. You're married, it's a $500,000 exclusion. And the Roth IRA conversion recharacterization, the ability to undo or change a Roth IRA conversion, that was repealed, so you can no longer do that. So there's a lot of corporate changes too, but I want to focus on individual today. If you'd like any more information, go to purefinancial.com.